Okay, so I thought maybe some of you would appreciate a bit of a market update from the perspective of a realtor. This is data that was compiled from the National Association of Realtors by Gary Keller and Jay Papasan and was presented at our Keller Williams event in August. And this data goes through July. Of course, it's November now, but it doesn't really change really the perspective of where we are in the market these days. So anyway, if we look at sales, 2010, 2011, they were at their all-time low. We have it says that we were on pace for the best year in home sales since 2006, and July over July sales pace has been 17.2% higher this year than last year. Prices, 17 consecutive months of year-over-year price increases, the first time this has happened since 2005. Median home prices up 25.1% from this past January to this past July. This is an interesting table. It says that if home prices had continued on the typical 4% trend line as they had back in 1989 and the years following, we had our jump in Baltimore started a little bit earlier than the rest of the country, but about the year 2000 we started to see increases, appreciation of about anywhere from 23 to 26% per year starting in 2001, 2, 3, 4, 5. Of course, in 2006 it leveled off, and this just says that if we had continued to grow at a 4% appreciation level, we would still be lower right now in the values of our properties. We would still be lower than we would be if we had just continued that 4% trend line. So I think that shows that things are still undervalued in the real estate market. We are starting to see appreciation in some areas of the county as well as in the city. So that's good news. Mortgage rates, 4.57, that's down to about 4 3/8 right now, I believe. Mortgage rates, 30-year fixed, the average has been 8.68. So again, we're still well below that. So that's a good buying sign. This just has to do with some of the mortgage regulations that have changed. It says that there's a shorter waiting period for consumers who experienced an economic event. Borrowers who defaulted may be able to buy after 1 year. I would say that that's probably closer to 2 years from what I've seen on the streets, but definitely that for folks that have been through short sales, that period is not as long as it was before. Typically it was 3 years before people could even consider buying again. This shows the inventory declined by 31% last year. What's driving demand? This is really interesting to me. When we look at household formations, we see that they were at their lowest in 2008, and that was exactly when we began to see everything topple or fall apart in the housing market. I noticed that in August of 2005, when Katrina hit the United States, all of a sudden we were looking on our televisions and seeing people on their rooftops, and we would say in our comfortable homes, well, at least I have a home. So we would no longer begin thinking about putting additions on our homes. If you remember back then, that's when the banks really started to cut down on equity lines, and they would send people letters and say, you could get $40,000 before, now we're going to cut that down to $8,000 or whatever it was. But if we look at what's trending, we see the projected household formation will be about 1 million in 2013 projected, and then 2016-17 somewhere in there 1.2 million households per year. That is a good signal, I think, for the housing economy, or housing part of the economy. Unemployment improves. So we look at this demographic of 25 to 34-year-olds. Back in 2010, it had hit 10.5%, and now it is down to 7.4%. or 7.5%, that's a good sign because, of course, the reason that this is important, the first-time home buyer market, is that everything is affected by that, right? So the second home, the third home, is all predicated upon more people being able to afford homes, getting into the housing market. This talks about the affordability index. Says due to rising home prices and higher interest rate, the National Association of Realty affordability index has declined 35% since January. So it's tougher to buy a house for folks. So that's not a good sign. Affordability is still above any pre-crisis level since the creation of the index. So that's good. What's happening in institutional investors? This shows that over 100,000 homes since January of 2012. So at this point, this would have been a little over a year and a half. $14 billion invested in real estate from mostly these five main players in the market: Blackstone, American Homes for Rent, Colony, American Home, Colony Capital, and Morgan Stanley. So these would be companies buying investment properties as rental properties, or they would be buying them for their real estate investment trusts. What is impacting supply? New home construction, distressed properties. So some parts of Baltimore County we're still seeing quite a number of short sales and foreclosures. Other parts of the county, not so much. And this pretty much isn't in alignment with the way it's been for the last 6 years. Those areas are still pretty consistently the same. Now, this was helpful to know. Builder confidence at an all-time low, 2010. That was really my worst year in 19 years. We're seeing that builder confidence up to 68 in 2013. That's a great sign. So distressed properties, completed foreclosures in July were down 25% the same month last year. So 25% lower in 2013 than they were in 2012. That's great news. Foreclosure inventory has declined more than 18% this year and is down 32% since last July. This is another helpful number. Underwater homes. 14.5% of homes are underwater, down from 21.7% at the end of 2012. 7% of properties returned to positive equity in the first 2 quarters of 2013. That is really great news. While interest rates have been low, and you would have thought probably 2011 was the very best time for people to be buying homes, and I was trying to get as many people as I could to think about that back in 2011. At the time, I felt like that was the lowest that we had hit, and I was trying to stir up folks. But unfortunately, people didn't have their own equity in their own homes that they could move on to the next one. So that's what stalled out the market from moving forward, even though the interest rates were so low. So anyway, we don't need to talk about Canada today, but hopefully this has been helpful. Thanks for listening.